Any advice and information from this podcast is general only. It has been prepared without taking into account your individual circumstances and needs. Before acting on any advice from this podcast, you should assess and seek advice on whether it is appropriate for your needs, financial situation, and investment objectives. And we are back. Hello, J-Mac. How are you?
Hello, Yannick. What's cracking?
We're getting there. I've been having sleepless nights essentially due to this investing thing. It's got me on the research bandwagon, but I'm excited. At the same time, I guess, as you know, we've been sort of tracking what's been happening in the Australian and global markets regarding that funny word of volatility with your friend Trump. For all our listeners out there, Jessie's currently wearing one of them red MAGA hats, but no, that's a joke. But he's definitely sort of contributing to that volatility we sort of talked about with some of his policies and actions and how that's reverberating around not only us as Australia, who we think was a solid trade partner, economical, defence, historical partner of the US, but global as well. How I guess some of his intents with tariffs are kind of fluctuating share prices, and there's some doom and gloom, and it's going to be a bull market, or it's going to be a bear market, and and on top of that, as we mentioned, there's been some clients that have emailed and called us with some concerns on, hey, my super's taken a bit of a blip. What's going on? We've sort of had to nurse them through that, but as you and I know, with our clients, if you are lucky enough to be one of our clients, we will hold your hand. I will give you a cuddle. Jessie, I don't know. But we will sort of coach you through and remind you of, I guess, the goals and the why that we discussed. Yeah, and that's a big one. It lets us, I guess, as a side note, we think on the rational side to help people with their finances, and this is a big part of where we earn our bickies per se, is sort of, hey, yes, the market is having a bit of a brr moment, but as we've told you, like when you invest, especially whether it's shares or real estate or whatever, there will be a big correction or a big market fluctuation. It's a bit different from real estate. You don't really read about it as much. That sort of runs on differing sort of cycles, but share market wise, whether it's a direct share in a company or indexes or ETFs, there will be another market collapse or correction as we've seen. And it's just winding back your plan, going back to your plan and going, why did you invest? What's your kind of long-term outlook kind of thing? So
it's
in
scary.
So in this episode, we're going to sort of talk about risk management. Or how we're going to go ahead sort of protecting your assets and kind of minimizing that risk in the short and long term.
Yeah.
Jessie, is that a question you've had to be asked? Like, it's definitely come up, especially when we talk about the share market side, besides people sort of thinking it's a bit taboo or going, it's quite risky, isn't it? Well, mate, you get hit by a bus when you hop out of your car the next day. That's risk. But by mitigating that, but some people sort of, what happens if I lose my money? I've seen that, GFC, people jumping out of buildings, all that kind of stuff. Is that the case? If the share market tumbles today, as it has in the last 2 weeks, it's, the ASX has dropped, I think, 10% or whatever. The S&P 500 in the States has definitely taken a hit. You mentioned the Tesla thing. Have they lost their money? Have those people that had shares in Tesla, have they lost all their money? Is that right?
Well, there's a term we like to use. You only capitalize your loss if you sell your shares.
Okay, or if you sell that, okay.
So it looks very scary, and we have a lot of people, kind of, well, Yannick knows, coming to us and showing us their super app or their investment app and going, why, my money's going down. Like, what should I do? This is, I don't want to see my money going down, but that's kind of a part of
the volatility
in an investor's journey. And if you have long-term goals, I know it's hard. It's very hard with your emotions when you see that happening.
I thought this investment thing was supposed to be easy. Just sign up to a platform, put some dollars in. Oh, look, 10% a year growth. I'm rich. So there's a bit more. There's a bit more to it. In that, okay, it sounds like this investment thing's got a lot more pieces to it besides just finding what the cheap fees are and finding a company or an index that you're happy with, or there's a lot more psychological barriers to it as well. That's okay. Is that worth a deep dive? Is that what we're going to go into now? Because is that part of it?
Yeah. I guess the best type of investor is one that can stay calm when they do see the market going down. The only reason, I guess when you see the market going down, yes, it's scary, but in the long term, as long as there's consumerism and people buying cars and phones and all that type of stuff,
which is the world we live in,
there's always going to be a company to take advantage and try and sell you something.
Okay.
Yeah, unless there's a zombie apocalypse, then we'll kind of be in bunkers and stuff like that, and you won't be worried about your shares.
Are there any companies out there that sell like a anti-zombie spray?
It's a good question, Yannick. I don't know.
I bet you there's a company out there that spruiks it that's worth like 10 cents a share. If I buy in now and this apocalypse that you talk about happens, this share price is going to go bananas.
Yeah, if you survive, it should be a good time for you.
Right. I know my next opportunity is coming, my little unicorn. Anyway, okay. No, fair enough. So part of the risk management, Jessie, look, there's probably a heap of ways that people can go about this, and we definitely coach people through this. But one of them, I guess, is, look, we talked about types of investments, traditional, alternative. How do I buy into them now that I'm ready, whether it's buying a house, getting a loan for that real estate investment, or finding start opening up a platform, whether it's through your bank or one of the trading companies or crypto wallet or whatever. So where am I going to put my bickies? Where am I going to put my dollars? How do I know which share to buy? Like, hasn't the ASX got, I don't know, over 500 companies? How many companies are publicly listed in the world that I could buy into? Isn't there like thousands?
Yeah.
So which one do I buy?
I don't know. I know. Well, there's different answers to that depending on your goals, but I think it's really good to diversify your portfolio.
Okay, is that sort of to do with like asset allocation? Is that right? Is that so diversification? So not having all, this is all kind of general, but you can have all your eggs in one basket, or you can have them kind of diversified in different baskets. Is that, okay, so that's the asset allocation sort of thing. Is that balancing everything out? Is that to do with, because I've noticed like when I read the news and clients definitely highlight it to myself, the mining sector sometimes or in some periods can outperform the banking sector. We've seen in the last sort of couple of years, the tech sector's just absolutely exploded. Tesla was killing it for a bit there, Meta, which is Facebook, but then you have periods where, as we said, like, whether it's mining, banking, consumer, like your Woolworths and Coles sort of companies, they're different. Okay, so is it like all these sectors kind of work a little bit differently? It just depends on what's happening in the global market or economic wise.
I think like you mentioned before, if you just went and bought shares in Tesla, it's kind of gone, what was it, 5% drop?
Yeah, in a day trading in the US.
Yeah, you'd be a bit worried because, you've seen such a dramatic drop in your money. But if you've got Tesla shares, if you've got Coles, say Westfarmers shares, banks, maybe you have a couple of shares in banks, then you don't feel as much as the pinch, as you said before.
Smooths it out a little bit, I guess. If you've got money in different little sectors, one might take a big hit, but the others might be doing really well or realising big profits. Especially the banks, they seem to sort of reap in profits most times. Okay, yep. And there was something that you mentioned on the ASX that happened the other day due to this last couple of weeks with the drop. What was that?
Yeah, we actually saw a media article a bit ago, and it said, and once you become an investor, you kind of see a lot of media articles scaring you a bit. This one said there was a $2 billion loss on the Australian share market.
Yep.
And, that's scary to see. You're like, oh, maybe if I have shares in that, ASX 300.
Yep.
Oh my gosh, do I need to sell it all and put in cash, or my money's going down? What's happening? And we worked out it was really only a 1% drop.
Yeah, true. The ASX is a pretty big beast,
because it's a beast. Yeah.
Right. Okay. So it's funny sometimes what the media can kind of do this is a story for another time, but I guess socials and media and what you get on your Google feed and your news feed might sort of have, different sort of points of view or agendas to it. So just be cognizant of what you're reading or what you're watching, and how you sort of relate to that. Some new media outlets might sort of portray doom and gloom, whereas other ones might be just purely kind of agnostic or neutral and just give you factual stuff. Okay.
Yeah. And Yannick, what would happen if, say, I saw my money down, or I saw that media article about a $2 billion loss, and say I sold my shares? What's kind of the implications of that?
Yannick can no longer answer that question as he has gotten scared and dived into the cold ice bath. No, that's a really good question. Look, it depends on your sort of goals. Not to harp on about it, but for me, it's a lot different to someone who might be in their 50s or 60s or might not be working at all. But I guess for me, if they're really good quality assets, if they're companies or shares that I really believe in that are consistent performers, I guess the analogy that we sort of use is, what's a good car company? Toyota. Land Cruiser is pretty popular as a four-wheel drive.
Mm-hmm.
If Toyota emailed you tomorrow or next week and go, hey, we're having a 15% sale, you want to buy something? The value is still there. We're just selling it really cheap. That's kind of how we sort of look at it. We're able to potentially, could potentially buy that same investment or the same asset, but at a cheaper price. I guess for me, I'm not too worried about what's going to happen tomorrow. I'm thinking of Fitzy working 1 day a week in several years' time. So if I can buy it cheaper today, I probably would have a bit of a jump on it. But everyone's different. Yeah.
So you're saying, when my shares go down, say in the ASX 300, and they've dropped 10% or they've lost $2 billion, is there an advantage to buying when they've kind of dropped?
Yes, well, there is if you want to buy and hold them. Because if they were $100 today and they've dropped 10% in a week, that means they're worth $90 next week. So you're saying I could buy one and a bit of those shares next week, buying it at $90.
So they're on sale?
God, if only they advertise it just like Myer or, I don't know, Kmart or whatever, like, come 50% off, Boxing Day clearance. Imagine if they had a Black Friday sale for shares.
Oh.
Yeah. Oh, it's too risky. But anyway, no, that's a really valid point. And that kind of, it's interesting because we touched on it before, whether most Australians like it or not, they have got maybe some piece of their super in those kind of assets like shares. So they can't really control how their super fund buys the shares, but essentially it's kind of, they're buying, the super funds are buying these investments periodically, aren't they? Regardless, usually as a give or take, regardless of price, they're buying them periodically, whether they're low, high, in the middle, because as we know, super's a long-term game, story for another time, but same rules apply. This month, they might buy that specific share at $1. Next month, it might be $2. The month after that, they might be buying that share for 50 cents. But I guess it kind of averages out in the long term, doesn't it? Yeah. Something along the lines of sort of like your dollar cost averaging. It's sort of you're continually buying something over set periods, but it's over time. So everything kind of averages out. I'm paying more now, but I might buy them cheaper in several months' time. Okay.
Yeah, right. So you're buying at the highs, the lows, everything in between.
Interesting.
Okay.
Yep. If there's sort of a long-term goal there, then it doesn't really matter if the markets do sort of, I guess if you're trading, it's a different story. You're trying to do that whole buy low, sell high kind of thing. But yeah, okay.
Yeah, right.
So yeah, like the markets will be volatile, won't they? There will be fluctuations. I'm sure if you Google or search engine, world markets, last 30-year performance, it'll come up with a graph and there'll be a heap of squiggly lines. There'll be a heap of big dips, especially, the 1980s Black Monday stock market crash, the dot-com bubble, the millennium bubble. The big one a lot of people remember is the GFC where, world markets plummeted by 30, 40%. That dirty flu that everyone got, COVID, just a few years ago, that was a big one. That was... everything was in red. Everything was hemorrhaging.
So what happens, Yannick, if we get another COVID, say COVID 2.0? Knock on wood, that never happens. But as we know, there'll always be a downturn in the market. What?
If it's COVID 2.0, I will add to my garage full of toilet paper. Yeah. Remember that epidemic?
That's your priority? Yep.
Oh, we don't need food. We need toilet paper.
Yeah. Gosh.
Anyway, yeah, it's it might not be COVID, but some sort of market event.
Yeah. What should we do?
Everyone's different, but it's not really the best idea to panic and sell.
It's hard when you're so emotional, isn't it?
I can imagine. That's where this whole psychology thing comes from.
Mm.
You're most likely a qualified psychologist. I'm definitely not. But
No.
remaining, as long as it sort of comes back to that having a plan. If your plan is there, then when that market meltdown happens, which it will, depending on time, just knowing that you're going to ride it out. Because if you whether it's your house or your shares or whatever, if you sell them, you're going to realize that loss.
Yeah.
Yeah, it's funny. I guess the analogy is, if you've got 1,000 shares of something, you bought 1,000 units of whatever shares, they're worth $1 each. Market explodes due to, I don't know, Trump slapping Putin, as we've sort of joked about. The shares you hold are now worth only 40 cents each, so it's dropped 60%, but you still hold 1,000 units. You haven't sold anything. So you still hold the same amount of units, but just the value at this point of time is just a lot less, just due to what's happened in the world. But all things being equal, we've had a few big sort of catastrophic events in the last 10, 20 years, GFC, Gulf Wars, Afghanistan War, Russia, Ukraine, Middle East. They've affected the markets, but I guess in a long-term trend, most of the major markets have headed in a certain direction. So it comes back to as you said, the mentality of it, and just giving that consideration. It's hard. It's easier said than done, though, isn't it? When you're watching your Actually,
I was telling you before about this. I was watching this video of this guy who had retired early. He was in his late 30s through to that FIRE movement.
Is that what you read from to get you 1 day a week working? Yeah. And
he knew he would be emotional if there was like a downturn. So he actually, and he'd go, oh, should I sell my shares? Should I? Because he was in it for the long term.
Yeah.
And he found that writing a plan for himself, if you feel like this, do this. If you feel like this, do this. And then it helped him, like you said, get that mental clarity.
Right.
Where maybe if you're panicking, then, you've still got this much coming in here.
Yeah.
If you feel that scared, get a second job or get another job or something like that. So
okay.
Otherwise, lean on your local financial advisor if you have one, and they can kind of walk you through it as well.
Yeah, I think if you come see us during a market meltdown, I think we help you, and we also provide one free bottle of snake oil.
Oh my gosh, the hugs and the snake oil.
Yeah, the ointment that fixes everything. Cool. I'll add that on with I think we also give you a 4-leaf clover from our stash.
Oh my gosh.
Yeah. Fair enough. Okay, so definitely sort of having it comes back to that why. If you're still years out from your sort of goal of accessing your money or cashing in on your investments, knowing that what's happening today shouldn't really bother you too much. If your plan was like, hey, in 10, 15 years, I want to build my portfolio up to take time off work or buy a house or, okay. So, and revisiting that plan gives you a bit more clarity, because I guess your plan might have come from a period, as you said, where it was derived from, a moment of sort of mental clarity, because look, sometimes bad events can happen in bunches, can't they? You could be having a real bad day at home. Kids might have, I don't know, they might have broken something real precious to you at home, and then you've come to work, and then the market's melting down. You've only on 2 hours sleep. You're watching your, whatever assets you hold are worth half of what they were a week ago. You've had your cold shower, you've cried in the shower, and you're about to hit the sell button, or you're about to ring your agent and sell it. But if you can revisit that plan that was written in a point of clarity, it might just sort of get you through it. Or you can come see us. We'll give you a cuddle, have a quick chat.
Snake oil.
Snake oil ointment. And then okay, all right. Yeah, it's funny. It's,
What's that quote from Warren Buffett?
I guess Annie Spruiks it in that sort of the moments where the market's doing a heap and you're reading a heap of hype on your socials or on your news feed, but sort of to be fearful when others are greedy and to be greedy only when others are fearful. So an example is sort of what we talked about, say COVID, markets were just, as in like asset prices were just plummeting through the floor.
Mm-hmm.
But these are all companies you and I know. I'm talking sort of about the Australian side. It's everyday companies that everyday Australians know and use, whether it's, I don't know, everyone shops at Woolworths or Coles, everyone banks at Westpac or Commonwealth or NAB.
Yeah.
Everyone flies Qantas or, all these top quality companies, but all of them were affected by COVID and their share prices plummeted. There weren't too many that really boomed. A lot of them, and that was internationally as well. Everyone was still using Facebook. Everyone was still buying. iPhone was still one of the leading, smartphone makers out there, but even their share price fell through the floor. So I guess some people saw that as an opportunity. You talked about that before. If there was an awesome product on sale for 50% off, would you buy more of it if you could? And that's kind of where I think he outlines being greedy when others are fearful. When everyone's selling all these assets because they've seen this little blip in the market, he's sort of mentioning, hey, if it's a good quality product or company or an asset, it could be a time to be a bit more greedy and look at buying more. And to be fearful when others are greedy, I guess that sort of we talked about market hype. Like sometimes there's some investment opportunities out there that just don't make sense. There's a heap of media behind it, a heap of social media.
Yep.
It's on the talk. It's on the gram.
The talk.
You got 13-year-olds talking about it. But I guess if you do your own investigation or if you're having a chat to your advisor and he's like, look, kind of looks sort of regular to me, unless I'm missing something. Maybe they're selling some snake oil. But, maybe just be a little bit hesitant on why it's a bit hyped up. Kind of think we talked about in another episode about GameStop. Like, I guess it was an okay company, but it hadn't really outperformed anyone in the last few years. And then its share price just exploded off the back of what? Just a bit of Reddit forums and a bit of hype. That's when I guess Buffett with his quote sort of talks about being a little bit fearful and others are being really, really greedy. So
well said, Yannick. Well said.
Oh, if only it was that easy, I guess. I'd be working one day a week, but no, obviously not.
And I guess the big thing people kind of see on movies and that is a lot of day trading as well.
Oh, man.
Yeah.
Wolf of Wall Street.
Yes, Wolf of Wall Street.
Money Never Sleeps, I think, is another one. There's some classics out there.
What are the kind of considerations, I guess, with day trading versus maybe long-term trading and the ASX 300?
Horses for courses, everyone is different, and there are heaps of people out there that have done really well with the whole day trading thing. So essentially, short-term versus long-term. Day traders are essentially buying and selling certain assets, whether it's crypto or shares, and gaining profit off the change in price. I might be a day trader who's looking to buy shares at $1, and then during the day, because of that short-term volatility we talked about, they might be sometime during the day they might reach $1.05 or $1.10, and I'll sell it at those prices, and there's that little bit of profit in between, and that's kind of where the day trading comes in. Like that's sort of how that works. Whereas I guess there's the buy and hold sort of long-term investor who potentially is happy to buy at $1 today. And as we just talked about, next week the news says that, I don't know, that company is down to 90 cents for whatever reason, but there's enough evidence out there and that company is a rock-solid company. You're willing to hold on to it for the long term because it's going to sort of bear the fruit. And I guess you think of like that's where kind of like your long-term holding is sort of, I relate it to maybe like your blue chip stocks, the companies, respectively to sort of like the ASX or your Australian companies, I don't know, like your BHPs maybe or your Commonwealth Bank. They're like your blue chip stocks, household names, are pretty reliable, pretty consistent. They're most not likely not going to go under for whatever reason. They're worth a fair bit. They've been around a fair while. They're very consistent in their earnings, how they spend their money. They're kind of like your buy and hold ones. So, yeah. And look, there's sort of some you mentioned on the day trading side, you can definitely do that. I guess, is there any other considerations if you're day trading? You can do it. Anyone, like as you mentioned, you could buy a share tomorrow and sell it the next day. But are there any implications that come with that?
I guess like all shares, there'll be tax implications, capital gains tax if you've made a profit.
Yeah, okay. Yep.
But might be worth noting, I think it's very interesting. There's people doing day trading 24/7,
Yeah, well,
on
crypto
Wall
lets you do that.
Street.
Yeah.
Yeah. And I guess people have beaten the market, say
There were definitely some
like
out there.
ASX 300, but
Yep.
they might have done it a few years in a row, but never consistently
Oh, like your fund managers.
outperformed the market. Yeah, which I think is interesting.
Okay. Yep.
But yeah, there's definitely day traders out there.
Yep,
You
or
can
short-term
have a
traders,
go. Yeah.
So you're still paying tax on the profits, aren't you? So same as our other episode.
Yeah.
Any profits will go into sort of your taxable income, or generally speaking, and you'll pay. Okay, and you don't get any discount if you're trading in the short term, do you?
No, because it hasn't been over 12 months.
It's
too quick.
Okay. So the day trading sounds pretty lucrative. Definitely looks good on the gram where you got some people spruiking, working from their laptop at the side of a pool, drinking a beer.
Oh.
Hashtag day trader. Put some orders in on your laptop. Sell. Make some buku, bicky profit. But what about the long-term investors? What are some of the benefits? Surely there's some benefits. This Buffett guy keeps talking about long-term this, long-term that. But like, what are some of the benefits from long-term investing?
Yeah, well, I think the compounding effect is a big one, especially if you're younger and you've got a lot of years ahead of you.
Do you have to be young though?
No.
Okay.
No.
What are you saying? I'm not young, or?
Anyway.
Good answer.
No. Yannick just turned 40, actually.
Whatever. Still 25. Still not prime. Whatever.
So just to give an example of the power of compounding, if someone was to, say, put $10,000 into an investment and it's returning a 7% return, if they don't do anything, they just kind of leave that money there.
So just compound interest.
Just compounding.
Year-on-year interest. Okay.
It's making 7% return or year on year. In 40 years' time, if you had a look, maybe don't look at it for 40 years and come back, then it's worth about $163,000.
Damn.
163, just for letting it sit there.
Yeah.
And
that's,
you go.
Wow, that's kind of like that passive income, passive wealth growth on the side. So while you're doing your Monday to Friday or whatever, I don't know, teacher, miner, bricklayer, accountant, whatever, you've kind of got this goal, you've got these assets on the side that are growing for you. You've kind of got a goal that, hey, at 10, 20, 30, 40 years' time, I want to have this much. You can kind of kickstart this, rely on the power of compounding interest, or as Albert Einstein, I think, mentioned, it's the eighth wonder of the world. Google that, fans out there, double check on it. But because you're getting growth on growth on growth, and that turns into, right, so 100 grand, 7%, 40 years would be 1.63 million. Yeah, okay. Yeah, well, that's something to consider. And it doesn't have to be 40 years, does it? Surely, like if you got, I think you've had clients, and I know I have, that have sort of had a goal of 5 to 10 years. Like, hey, I seriously want to maybe have 50% of a house deposit, not just 20%.
Yeah.
And that gives you a bit more scope to maybe invest in these assets and potentially work towards that goal. Because, saving a considerable amount, it can be challenging, especially in this day and age. So having assets or investments on the side outside of your normal income, growing in the background, can definitely help you sort of come up with that. Right.
And lastly, Yannick, what's the rule of 72?
The rule of 72. This is like some sort of exam. I'm sweating here. Turn the aircon on. So simple kind of on the rule of 72 to do with the compound interest, essentially to get a rough estimation of how long it will take for your capital, your money to double, you grab the interest rate that you might be getting on an investment and divide 72 by that interest rate. Let's just say I put my money in a bank at 8% a year. 8% a year. 72 divided by 8. My money, or essentially that principal amount, will double in value in about 9 years' time. That's sort of using the rule of 72. And you can sort of chop and change that depending on, I guess when we talk super, which is a discussion for another time, we sort of outline the 10-year average of returns because super is a long-term game, and you're trying to have a look at how long it will potentially take for your investment to double. And that gives you a ballpark figure when you're working towards an amount that you want to try and grow your funds to. It's not a perfect rule, but it definitely gives you a very good ballpark indication of where you might end up with your funds. So, J-Mate, that's another episode pretty much wrapped up. That's tying in pretty nicely. So, essentially, risk management. I thought it was easy, but there's this whole psychology to investing, making sure you're making the right choice. Would you say there's about 1,000 investment options you can buy out there? Which one to buy? Why am I buying? They're going on sale. Should I buy more? Oh, GFC's happened. Oh, my God.
It's a lot, isn't it?
There's a lot to this. If only I could just outsource these problems to like some sort of financial professional and just go, here,
Nice
deal
plug.
with it. Call me if World War III happens or if I should buy more.
Yep.
Is that what you do?
Yep. Yeah, sure. Let's hope it's no World War III, though.
Yeah, that's a problem for another day. I don't know.
I'm getting deep now.
Yeah. Okay, cool. Thank you, J-Mate. We will we'll see you soon. To everyone else out there, stand by. We will have some more episodes on investment coming your way.
Thanks, guys.
Ciao.